Today, the economic rift. The DFA daily to the 22nd of July 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and problem news with a distinctively Australian flavour and with a touch of philosophy on the side. More economic data today, which reveals quite a lot, but also masks some other things. The 6-month annualised growth rate in the Westpac Melbourne Institute Leading Index, which indicates the likely pace of economic activity relative to trend 3 to 9 months into the future, rose from minus 5.29% in May to minus 4.44% in June. Despite another modest improvement this month, the index growth rate remains in deep negative territory, consistent with a recession. Easing social restrictions have allowed for some lift in activity in June, and that is best captured by the increase in contribution to the growth rate in June from US industrial production, added 1.1 percentage points, and hours worked, added 0.6 percentage points. The lift in hours worked in June, which is an ABS estimate showing a 4% rise, is particularly encouraging and means that the contraction in hours worked through the whole of June quarter was only 6.9%, compared to the 20% contraction originally expected by the official sector. That puts some upside risk to Westpac's current forecast of a 7% contraction in the economy in the June quarter. However, the developments in July, including the renewed shutdown in Melbourne and the associated 6.1% fall in the Westpac Melbourne Institute Index of Consumer Sentiment, suggests that the profile for the recovery will not be smooth. Westpac is forecasting the economy to grow by 3.5% in the second half of 2020, but they've recently moved more of that recovery from the September quarter to the December quarter. Needless to say, the first half of 2020 has seen a dramatic weakening, with the leading index growth rate dropping nearly 4 percentage points between January and June, the 3 months to April marking the sharpest decline in the 60-year history of the measure. Looking over the full 6 months, two components account for the bulk of the slump: US industrial production down 2.2 percentage points and aggregate monthly hours worked down 1.2 percentage points, both recorded exceptionally large contractions as shutdowns impacted through April and May, posting gains in June as economies started to reopen, but with activity still well down on the pre-COVID levels, which is 10.8% down in the case of US industrial production and 6.9% for aggregated hours worked. Other components have had a more mixed contribution over the first half. Equity markets have provided a further additional 0.5 percentage point drag, with a further 0.4 percentage point drag from dwelling approvals, which posted a particularly sharp 16.9% fall in the May month. However, this has been partially offset by more supportive reads on commodity prices, up 0.3 percentage points, and the yield spread up 0.3 percentage points. Sentiment-based components have also had a mixed impact over the first 6 months, but, as noted, showed a sharp decline in early July as the return to lockdown conditions in Victoria impacted. The Westpac Melbourne Institute Consumer Sentiment Expectations Index fell 10% in the month, while the Westpac Melbourne Institute Unemployment Expectation Index jumped 12.1%, indicating a significant worsening in the outlook for the labour market. Overall, the component mix points to downside risks near term, with the drivers behind the weak July readings on sentiment likely to impact on other, less timely components that track real activity in coming months. Yesterday, the government released its extensions for the JobKeeper and JobSeeker packages. The JobKeeper extensions only run to March, and Job Seeker to December. The near-term extensions are broadly in line with the estimates underlying their earlier forecasts for a $240 billion budget deficit for 2021. But their forecast assumes additional stimulus of $15 billion to be announced in the federal budget in October and a further $15 billion to extend both JobKeeper and Job Seeker through to the end of the fiscal year. Consequently, if the government's estimate of the budget deficit in tomorrow's economic statement includes no more policy adjustments, we would expect an official forecast in the order of $210 billion, which is $30 billion less than the $240 billion. What is clearer after yesterday is the likely financial injection from government policies into the economy in the December quarter. They'd expected around $15.6 billion, but that now appears to be lower at $13.5 billion. The challenge for the economy, given that the stimulus in the June quarter was an estimated $65 billion with a further $95 billion for the September quarter, is to adjust to such a sudden reduction in the size of government support. And UBS says that the 6 months extension of the JobKeeper wage subsidy is a longer extension than flagged by previous government comments, and hence a bigger fiscal stimulus than UBS expected and probably more than most had predicted. However, the government still has significant tapering in the programme, and the payment rate will change from a flat $1,500 per fortnight for all on JobKeeper until the end of Q3 2020, which currently covers 3.5 million people, or around 30% of pre-COVID employment, to a new two-tier system, which will be phased out over coming quarters. For the fourth quarter 2020, the new higher rate is now $1,200 a fortnight for those working 20 hours or more per week, as well as a lower rate of $750 for those working less than 20 hours. Then in the first quarter 21, the rates will be reduced again to $1,000 and $650 respectively. The changes are especially designed to limit the estimated 1/4 of those on JobKeeper who have been receiving an average $550 more than their prior wage compared with their wage from the single employer paying the JobKeeper, albeit the actual incidence is less, given many of these workers are casual and or part-time and work multiple jobs. Meanwhile, the business eligibility test was also tightened from a once-in-all-time approach, which previously meant all businesses automatically qualified for the full initial period of 6 months based on projected turnover, to a new quarterly assessment based on actual turnover, remaining down continuously over each quarter compared with the pre-COVID level. However, the threshold amounts are unchanged at down 30% for small businesses with an annual turnover of $1 billion or less, and down 50% for larger businesses with turnover greater than $1 billion, and down 15% for the NFPs. This second phase of JobKeeper is expected to cover 1.4 million employers in the fourth quarter and 1 million in the first quarter, versus, of course, 3.5 million now. The extra cost is $16 billion, of which they estimate $10 billion is in Q4 and $6 billion is in Q1, with the total cost of JobKeeper now $86 billion, compared with $70 billion previously. Elsewhere, the Job Seeker COVID supplement payment was also reduced to $250 a fortnight for the fourth quarter, compared with $550 from Q2 until the end of Q3, reducing the total Job Seeker amount from $1,100 to $815. It will then be renewed again later this year for a likely further temporary and or permanent increase. However, the income-free threshold for those on Job Seeker was increased to $300, albeit the mutual obligation job search test and the asset means tests were reintroduced, and the extension of the Job Seeker top-up will cost $3.8 billion extra, raising the total cost to $18 billion. The extension of JobKeeper and Job Seeker announced today is worth a combined $20 billion, or around 1% of annual GDP, albeit concentrated in the fourth quarter. Hence, this reduces the downside risk for growth and employment in the fourth quarter, and they were particularly concerned that the end of JobKeeper would have driven a second wave of job losses, with UBS analysis of ACA data showing that 48% of SMEs saying they were likely to reduce employees if JobKeeper payments were not extended. The extension reduces the $100 billion quarter-over-quarter policy cliff that they flagged in the fourth quarter, but it is still very large, around $84 billion or 17% of quarterly GDP. And the ABS provided a preliminary estimate for Australian retail turnover for June 2020, compiled from preliminary data provided by businesses that make up around 80% of total retail turnover, and of course it is therefore subject to revision. The final monthly estimate will be published on the 4th of August. The seasonally adjusted estimate rose 2.4% or $694.7 million from May 2020 to June 2020. So Australian turnover rose 8.2% in June 2020 compared with June 2019. This compares to an average annual movement in 2019 of 2.7%. There were large increases in turnover in cafes, restaurants and takeaway food services, and clothing, footwear and personal accessory retailing. While some restrictions on trade remain, many businesses saw a full month of trade in June, having been closed for the first week of May 2020. Rises in cafes, restaurants and takeaway food services exceeded 20% for the second consecutive month, but it will remain 17% below the levels of June 2019, while clothing, footwear and personal accessory retailing rose around 19%, remaining 6% below June 2019 levels. Food retailing rose 0.9%, following a 7.2% month-on-month rise in May, and remains elevated in the through-the-year terms. Analysis of supermarket scanner data shows that compared to June 2019, perishable goods rose 14.4%, non-perishable goods 12.4%, and all other products 7.8%. The annual growth reflects a continuation of more food being prepared and consumed at home due to social distancing, and at the end of the June month there was some evidence of stockpiling of goods such as toilet paper, flour, rice and pasta. At the aggregate level, stockpiling is most evident in Victoria. Household goods retailing fell in June 2020, though remains 23% above June 2019 levels, and department stores saw a significant fall after a large rise in May 2020 in seasonally adjusted month-on-month terms. But caution needs to be exercised when interpreting this preliminary data, as they may be significantly different in the final published estimates. That's due to a number of factors. Estimates are based on preliminary data provided by businesses that make up around 80% of total retailing turnover. Where respondents have not yet provided their data, it's estimated or imputed based on previous responses or averages from similar responding units. The level of imputation in preliminary estimates is significantly higher than for the final estimates. The quality of imputation for preliminary releases may also be poorer than for final estimates due to the higher level of non-response. And furthermore, historical imputes, which are based on data from previous months, may not accurately reflect changes in the economy due to recent events. And changes to imputation methods have been made from the March monthly release to ensure non-respondents are more accurately reflected by the responding units in the current COVID environment. Until February 2020, retail trade used the concurrent seasonal adjustment method, meaning that seasonal factors were re-estimated each time a new data point becomes available. If not appropriately accounted for, unusual real-world events such as COVID-19 can distort estimates calculated using this method, and so from March 2020 seasonal factors were calculated using data up to and including February 2020, then projected from March 2020 onwards. And this approach, known as the forward factor method, ensures that the seasonal factors are not distorted by COVID-19 impacts. But of course the truth is that the whole market is distorted by COVID-19, so their seasonal adjustments may not be that accurate. Meantime, the Australian Prudential Regulatory Authority has published a speech delivered by Chair Wayne Byers to a meeting organised by the Trans-Tasman Business Circle. In flattening the curve, Mr Byers provided an update on how APRA is seeking to support the soundness and stability of Australia's financial system during the biggest and most sudden economic contraction since the 1930s. He said, "We cannot avoid or hide from the long-run impact of a shock, but macro and microprudential measures can assist in making the adjustment process more orderly and limit unnecessary costs. In the same way that governments and health professionals have sought to flatten the curve of new infections, the challenge from an economic and financial perspective is to find a way to reduce the speed and depth of the contraction, as doing so is also likely to minimise its longer-term damage. The approach that APRA adopted to loan deferrals sought to strike a balance. By extending the concessionary approach until the end of March next year, they sought to remove regulatory disincentives to banks offering additional support beyond the end of September. At the same time, they have made clear that banks should only offer further repayment deferrals in cases where they have some degree of confidence the borrower could return their loan to performing status. And APRA will be updating their capital management guidance next week, and they will modify the guidance and extend it for the remainder of the calendar year, shifting from the immediate short-term emergency response in April to a setting with a somewhat longer-term outlook. Their goal is to ensure that capital management practices clearly have regard to the continuing uncertainty in outlook, that stress scenarios can be overcome without having to resort to cutting business activity, and that regulated firms are not unduly constrained from raising capital if and when needed. And he said, "I want to be clear, we have no intention of creating a capital cliff face that banks or insurers need to rapidly climb. As we've done in the past, our approach will be to allow banks and insurers to rebuild to the extent any rebuild is even required in an orderly manner and in a way that doesn't unnecessarily constrain activity or economic growth." Or reading between the lines, it seems to me that APRA is signalling that the banks will be able to start paying dividends again relatively soon, and APRA will continue to be generous with regard to the way the banks will have to manage and report their capital. Of course, the question is that building more risks down the track? Well, I guess we'll have to wait and see. And the Australian Securities and Investments Commission have decided not to appeal to the High Court its case against Westpac for alleged responsible lending failures after the heads of the Reserve Bank of Australia and Treasury both privately warned it would exacerbate economic uncertainty caused by COVID-19. Sources told the Australian Financial Review that ASIC's leadership group met for several hours last Friday and on Monday, with an overwhelming majority of ASIC commissioners voting against appealing the so-called Shiraz and Wagoo case. It lost twice in the federal court. Instead, ASIC plans to write to Treasurer Josh Frydenberg, recommending reforming the credit laws to clarify how responsible lending operates in the future. And the AFR said it's understood that the RBA Governor Philip Lowe and the Treasury Secretary Stephen Kennedy cautioned ASIC Chairman James Shipton that an appeal to the High Court could dampen lending by banks and undermine the economic recovery during COVID-19. That members of the federal government are anxious that an ASIC appeal would create legal uncertainty that could exacerbate a slowdown in bank lending and hurt the economic recovery from COVID-19. The Liberal chairman of the Parliamentary Joint Committee on Corporations and Financial Services, James Patterson, last Wednesday pressed ASIC's Mr Shipton about whether it was time for ASIC to accept the umpire's verdict after its appeal loss in the full federal court in June. And in ASIC's own release, it said ASIC will not seek special leave to appeal to the High Court in the Westpac responsible lending matter, following the full federal court's 2-1 decision to reject its earlier appeal. While it would have been open to ASIC to seek special leave to appeal to the High Court to obtain a ruling on the construction of the statute, ASIC is mindful of the impact of the additional time required to resolve this matter in the current challenging economic circumstances, as it will review its updated regulatory guidance RG 209 and will consider what implications the Federal Court decision has for that guidance. Any reform of the National Consumer Credit Protection Act to clarify further the enforcement of those principles is ultimately a matter for the federal government and Parliament. Bearing in mind the economic circumstances, it's important to remember that under the National Credit Act, responsible lending obligations do not apply and never have applied to loans made for business purposes. So in a way that you can see both APRA and ASIC rolling over and having their tummies tickled by the banking sector and by pressure from both government and the Reserve Bank. The trouble is, of course, that all of this puts more pressure on banks to lend, and we already know that many banks are still, frankly, lending more than they should. Now, finally, across the ditch, ANZ, the country's largest bank in New Zealand, says that the fiscal support measures for the economy there are doing the trick, and they now see the downturn in the housing market coming later and being somewhat less severe than they earlier forecast. Just 2 months ago, ANZ economists were predicting house price falls of 10 to 15%, but with a risk they could fall by even more than that. But in their latest Property Focus publication, they now see house prices falling by just 5 to 10%. Additionally, this fall is now expected to occur a little later, with the brunt of the impact occurring at the end of this year and into next, once the labour market situation becomes clearer. This is a smaller fall than we previously feared, with a less aggressive subsequent rebound, they said. We aren't ruling out a larger fall. There are clearly significant downside risks, but we are now more comfortable that stimulus is providing support and a bigger drop may be avoidable. The economists say their central view is still trends in the housing market have dramatically changed and that this will weigh on prices. But we now assume some of the offsetting impact from policy supports, temporary boost to cash flow like the wage subsidy and mortgage deferment schemes will end, but house prices tend to be quite persistent. So this boost will linger. Meanwhile, low and potentially even lower interest rates will be with us for a while yet, especially given our expectations that QE will increase to around 90 billion New Zealand dollars at the August Reserve Bank Monetary Policy Statement. At the moment, the RBNZ's large-scale asset purchase program, or QE, is set at $60 billion. The ANZ economists say that if the housing market drops by more than they currently expect, they think the Reserve Bank will pull out all stops to shore up the outlook. In fact, we cannot rule out the Reserve Bank deploying a negative official cash rate if the outlook was deemed bad enough and the associated risks worth taking. At the moment, the official cash rate is at 0.25%, and when dropping it to that level from 1.25% in March, the RBNZ indicated it would leave it unchanged at that level for 12 months. At the time, it ruled out using negative interest rates because some bank systems simply were not prepared for this. But subsequently, the central bank has refused to rule out taking the OCR negative at some point, and it has asked all banks to have their systems able, by the end of this calendar year, to handle negative rates. A negative OCR could unhelpfully impair credit supply, the ANZ economists say. However, such a tightening would potentially be concentrated in riskier sectors like business and commercial property lending. This could be bad for investment, but not necessarily such a headwind for the residential property market. A negative OCR would lower mortgage rates and boost asset prices, which would likely lead to net positive impacts on the housing market if deployed, providing eventual support in the event of a sharper correction. And the economists say their expectations that we may see a smaller house price fall than previously assumed will mean consumption may be slightly stronger than otherwise, but still weak. House prices affect household spending through impacts on net worth, confidence, and durables purchases associated with house sales. Spending is expected to be tempered by these effects in the period ahead. More striking is the impact that a weaker housing market could have on new home building and renovations, both of which tend to be spurred by developments in the existing property market. New home building is expected to drop potentially quite sharply from its recent highs. The extent of this impact is highly uncertain, depending on how housing market and other domestic economic developments evolve, and the degree to which new home building by the government takes up some of the slack. Reflecting this weak outlook, confidence and profitability expectations among builders are very poor. For these firms and those in the retail sector, the outlook for the housing market will have a significant bearing on profitability. And with housing a bellwether of the domestic cycle, other industries will not be immune should the housing market take a significant hit. So they said, we continue to expect that the GDP will contract 7 to 9% over the year. However, the outlook remains highly uncertain, and a better house price outlook tempers some of the downside risks we see around this forecast. So that you can see here, and of course in Australia too, how the housing sector is seen as a bellwether for the economic performance. Of course, the trouble is that to make this work, you have to find people who are willing to take bigger loans and gear up even more at a time when unemployment is much higher than it was, and when risks in the system are considerably higher, and when banks might be tighter in their lending standards. So we do seem to be skating on thin ice here. But as I said at the beginning, there is a rift between what governments are hoping will happen in terms of economic recovery and the reality relating to the fact that the virus, certainly in Australia, is really not in control in some major states. And of course in New Zealand it's well controlled at the moment, but the question is, will that remain so? So the risks, I think, are significant, and the rift between the positive expectations from government and indeed from the Reserve Bank in New Zealand and Australia and reality may well be stretched in the months ahead. We'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.